Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Hi, everyone. Welcome back to ETF Market Insights. I'm Erin Allen with BMO ETFs. A few weeks ago, we at BMO ETFs announced that we were bringing the widely known US SPDR sector ETFs here to Canada. So now you can access all 11 of the sectors of the S&P 500 index here in Canadian dollars on the Toronto Stock Exchange. For those of you who might not be familiar, the sector SPDR ETFs in the US track well-known indices that are really widely recognized as the sector benchmarks in the world. And they're some of the most traded and liquid ETFs in the world as well. Not to mention, they have over 20 years of a track record, which can be very helpful when we're looking to analyze different trends and sectors over time, which we'll get into a bit today. So we've launched these ETFs here in Canada in both a hedged and unhedged version, which really just gives you the flexibility to make your own call, not just on which sectors you want to be in, but the currency exposure as well. And then one last thing to note is that consistency is key. And that's why we have basically just added a Z in front of the US listed SPDR sector ETF tickers to make it easy to follow. So I've got a visual here on the screen where you can see all of our tickers if you want to learn more. But today we are going to do a double click and dive a little deeper into sector investing more broadly with Joe Nielsen, Head of Specialists Index Investment Strategy at S&P Dow Jones Indices. Before we do get started, a quick reminder that today we're not providing investment advice or recommendations. As always, today is about information and education. So Joe, welcome to the channel and thanks for joining me today.
Yeah, thanks for having me.
I think it's been a while since you've been on. Last we chatted about the SPIVA research, the active and passive. So I would love to have you on probably in the spring when that update comes out too, so we can dig into that again. But today we're here to talk about sectors. So let's kick things off. Hoping you can give us a bit of an update in terms of sector performance and what we're seeing on a year-to-date basis, just to get us started.
Sure, I can talk about year to date and how we kind of got here. So February is interesting. We're almost through the month, and it's turning out so far to be the fourth month in a row where sector spreads are in the double digits. And what I mean by sector spreads is really simply the difference between the best and the lowest performing of the 11 GICS sectors. Now, leading into February, January was the third in a row, obviously, that spread was wide, and that month it was about 12%. Interestingly, information technology, that was the only sector that was negative for the month. It fell about 2.9%. And if you recall, it feels like ancient history now, but it's that kind of DeepSeek AI, upheaval in the market where the competitive landscape was thought to be changing dramatically in that space, leading to nearly 800 billion in U.S. market cap leaving from one constituent in a single day. And so that was a big upheaval. But now in February, here we are. So year to date, when you look across these 11 sectors, you'll find that technology and consumer discretionary are the two biggest decliners. Those are down 2.3% and 4.9% respectively year to date. Now, it's a little interesting when you peek into the drivers of the performance is that so far year to date, two stocks, Tesla and Amazon, were the biggest detractors, not the only ones, but two of the biggest ones from consumer discretionary. But in January, Amazon was actually the biggest positive contributor to that sector. So the takeaway is that there's a lot of movement within these sectors that are defined, in very transparent ways that help us understand certain industries. But the lesson I take away from this, and you'll see it again and again, is that number one, it's hard to predict single stock moves. And number two, particularly in local markets, it's been pretty unpredictable lately. I think there's a lot of searching for conviction among various market participants, thinking about how to move forward with the tariff talk and what's happening geopolitically, as well as in the domestic economies of North America. So going back to what's been working, we've seen defensive sector tilts within the U.S. have worked off very well this year. So healthcare and consumer staples are two of the best performing sectors year to date. They've outperformed the S&P 500 by 5.4 and 4.7% respectively. And if you take that analysis up a level, you really see when you look at these kind of ups and downs of different sectors, often it's the case that when the largest market cap stocks in the 500 are underperforming, those are the times that we find that more sectors are outperforming because you're taking the influence away of those large
Mhm.
mega cap companies that typically drive it. If they're bringing the index average down, more sectors outperform, which is why at this point in time, 8 out of the 11 sectors are beating the S&P 500 so far this year.
Interesting. And then do flows match up, or can you do a little double click in terms of flows, what we're seeing in terms of sectors maybe over the past 3 to 6 months and outflows as well? Are they matching up with the
Sure.
performance?
Well, it's interesting. Flows, I think, particularly in sectors, are they can be sometimes illuminating, but also misleading, right, in terms of directional sentiment. And the reason for that, I'll touch on in a moment, is because they're traded so much. Now, if you look across these 11 these ETFs that are tracking the select sector indices in the U.S., it's over $300 billion in AUM, right? So as a complex, it's up there within the top category of funds, and it's within that overall sector market globally. Those are about 60% of the assets, right? So there are others, but these dominate. These spiders do. Now, at the individual sector level, flows might be a little more illuminating, right? So if we look year to date, we've seen financials in the lead, brought in a little over $3 billion US, followed by communication services with 960, and then utilities about 760. Energy, on the flip side, has bled out about 2.4 billion year to date. Healthcare about $500 million, and then materials following that. Now, when you look at this compared to the entirety of 2024, you'd see that financials brought in 3.9 billion for the whole year. So we're almost at that level right now, right in early 25. Industrials and tech followed, right? Some of these more cyclical sectors, but within those flows, much of that came in the fourth quarter. Again, last year, energy was the biggest loser in flows, out about 3.5 billion, and healthcare and comp services together were about another 3 billion of outflow. Now, as I mentioned, what is difficult to tell from flows within the sectors is that it doesn't necessarily reflect their popularity as a complex. Because if you look across all 11, you'll find there are inflows into one or two or three and outflows from others. And I think what may be more useful is rather than netting out those flows, which when you sum them up, right, if you have a billion in and someone's trading and changing their strategy, it's going to net to zero.
Right.
Trading activity, though, can be highly illuminating. And when you look at the traded value for these sectors, right, what's the turnover? What's the dollar amount of the shares at traded hands? That number is $2.5 trillion with the T.
Wow.
Okay, and so this year we're sitting at $371 billion in traded value for those sectors, which already exceeds their AUM, right? And so when you kind of work backwards from that, you'll find that it suggests the average holding period for the sectors is around 1 to 3 months, right? Now that doesn't mean that's what all users are doing. That means there is on one end a series of high frequency traders who use these in fast and furious fashion, right? And then the other side, there are people who are more long only or maybe have much lower turnover, rotation strategies. But it is really interesting. I think there's maybe only one or two ETFs that surpass that kind of turnover in any given year. And what that begets is this so-called liquidity ecosystem we talk about a lot, where you have not only the trading volume on the ETFs themselves, but also this kind of jungle of derivatives and options and futures based off of the ETFs and their indices, and strategies that surround that. And so you're seeing that a lot in the select sector in the 500 complex as well, where these kinds of instruments are allowing a lot of trading to go on in tandem with the ETFs that creates that kind of hyper volume that we see.
That's one of the things I'm most excited about is the liquidity of the fact that we, with our BMO sector spider ETFs, are wrapping the US listed version. We're really going to benefit from that liquidity market here in Canada as well. So I think it's an excellent
Mhm.
advantage. So you mentioned a lot of trading going on in sectors. There are different ways that you can invest in them, different strategies you can take. One popular approach is to look at them as, defensive or cyclical sectors and position that way. So can you sort of give us an overview in terms of how you would classify the different sectors and then how this can help inform your investment decisions?
Sure, and I think a lot what I'm about to say is fairly non-controversial. Although some people may argue that on the margins there are certain sectors, is it cyclical, is it defensive, and you can really look at the performance characteristics, but also the economic rationale for why you think certain sectors might do well in different kinds of environments. When we say defensive, we're talking essentially about the sectors among those 11 that have a lower beta, right? Generally less than one, lower volatility, and those that tend to do better in markets that are stressed or falling, right, on a relative basis anyway. On the flip side, you have your more cyclical sectors, things like financials, information technology, consumer discretionary, right? It's right there in the name. If these are discretionary consumer expenses, these are the things that hypothetically people don't buy when they can't, right? When times are tough. Staples are on the other end. That's a more defensive strategy, right? That everyone was clamoring for, certain goods like water and toilet paper, whatever, in a crisis like COVID, right? But it's not to make light of it, but there are things that we just need, and that makes that sector much more stable over time, along with utilities, healthcare, things like that. So when you split the universe up that way, you'll find this kind of on one side the defensive staples, utilities, healthcare, communication services, and energy to a degree. And the other side, you have materials, industrials, consumer discretionary, information technology, and financials. All of those are much more sensitive to the economic environment. And we put a paper together last year where we took those two kinds of blends, right, and just equal weighted each of the five. We left real estate out because it kind of sits in the middle, and it's 5 and 5 is an easier combination, right? We ran those blends through all of the financial crises and recoveries that happened since the beginning of the year 2000, right? So dot-com crash, GFC, COVID, et cetera, the 2022 bear market. And we looked at how those blends performed with some basic rebalancing to get back to that equal weight throughout the periods, and both of them beat the market over time. You find that individually, the defensive sectors outperformed in falling periods about 3/4 of the time, and about the same for the cyclicals as well. Right, so there's a lot of consistency to be found in putting these blends together that lean into that economic environment without trying to do it idiosyncratically with single stocks.
Okay, that's awesome. And then, of course, sectors have been a hot topic because of all the tariff news. Um, Sector Spider ETFs are focused on US sectors, but talk to us a bit about why it's important to look beyond where the company's domiciled to things like revenue to get an idea of how they might react to things like tariffs.
Sure, I think revenue, you nailed it, is really a key key component when you're looking at companies or any exposure, any index for that matter. And I think that, as I'll share in a moment, some of the details we found out about the 500 are interesting. In an environment where trade conditions are tightening, you'd expect sectors that have predominantly domestic customers, i.e., here in the United States, offer greater safety than those that are connected to international markets. And so, rather than thinking about the country of domicile, we look at revenue. Now, in the S&P 500, you have 500 companies that are all domiciled in the United States, but in fact, only 71% of their total revenues come from the U.S. Right? Another 10% of that leftover portion is from Europe. Another 10% from Asia. The rest other places. So it shouldn't be terribly surprising, although the number sometimes is. But when you think about the business models, particularly in certain sectors, these kind of multinational large cap companies are increasingly global. Now, US companies with greater foreign exposure have actually outperformed their domestic counterparts since 2017 when we started these different revenue exposure indices to measure that. And so it's rather notable that outperformance, especially considering the fact that the dollar's been strengthening over that whole period, which is typically a headwind for companies with foreign exposure and who are in a greater share there.
Yeah, you have a great paper on that we can also link below to give some more insights around that. But it's very interesting. Building on that, are there sectors that get the majority of their revenue from the U.S. or otherwise get the majority of the revenue from more international based
Sure,
geographies?
I can lay out some of the ends of that spectrum for you. As you might imagine, the ones that are probably the most U.S. bound in the revenue are utilities, right? We measure that. They're providing power and water, et cetera, to U.S. customers, and that's where the revenue comes from, right? Healthcare is number two. That's mostly U.S. driven revenue, is still over 80%. When you go to the other side, you can probably guess as well that information technology is the sector where the lowest relative proportion of revenues comes from U.S. customers, right? It's probably close to 50-50, but maybe slightly more from overseas, depending on when you do that measure. You'd also see the same in materials and energy, right? These are very much kind of export-heavy industries that I think maybe it's a similar case in Canada, right, where a lot of the revenue is coming from sources outside of the borders.
Interesting. Now, we talked a little bit about a business cycle approach to investing in sectors, you even touched on an equal weight approach, but what are some other strategies that you can kind of bucket in terms of how investors can use sector ETFs?
Sure, I think there are new ways people are coming up with all the time. So put it there as a caveat. But I think, and as you said at the beginning, this is not investment advice, but it's an observation of what I've seen savvy investors of all kinds doing really around the world in a lot of different types of channels. And I think one, as I kind of touched on a little earlier with the example of what happened year to date in consumer, is the ability to bet on a sector without taking on too much idiosyncratic stock risk, right?
Mm.
Talk about Amazon being on both sides of the contribution table. This is important, and it can be a short or a long-term way of approaching things. You can let sector rebalances do the work in the sense of figuring out which stocks should be included and excluded. Back to that sector paper we mentioned with the blends, one of the things we did also was look at how much of a single stock's price variance is explained by its sector, right? If you think about how much does your child's height determined by how tall the parents are, right? It's that sort of thing. And we found that about 50%, or roughly half of the stock's daily price changes are a result of the sector that it is a part of, right? So, and that's probably one of the biggest determinants. Now, knowing that, this plays out in some strategies, right? Knowing how hard it is to really pick a stock that's truly different. And I'll give you an example. If you looked at the tech select sector back in 2002, right, which is the earliest I was able to pull yesterday in the data, you would see there are 96 constituents in that index at that time. Now, could you have guessed how well all those 96 would have done going forward if you're trying to do stock selection? I'll tell you how hard it might be when I reveal that 70 of those 96 are no longer in the index today, right? So if
Wow.
you put yourself in those shoes back then, could you have picked out the 26 out of 96 that would have survived? I wouldn't bet it on myself to do it.
No.
Um, but despite the fact that the majority of them fell out of the index for whatever reason, that select sector outperformed the 500 by 500% over that time, which is about 2.5% per year. Right. So again, the sectors aren't static. They're always sort of evolving with inclusion and exclusion, right? Members coming in and out based on what the rules say and based on what's happening with winners and losers in the economy. And then you mentioned SPIVA in the early part of this call. I think that actually relates here around the persistent challenges of stock selection and what managers face. And as a result, we're seeing more and more managers use, and individuals for that matter, use sectors in place of single stocks to get that exposure to a theme, right? Whether it's semiconductors, right, or energy, whatever they feel is appropriate, and leading into it without having to think about every single company on a day. Now, a second item we talked about a little bit already was creating blends around the economic cycle, right? And you
Mhm.
get again put together defensive and cyclical, toggle those in and out. We see folks doing that in their own strategies or in active funds as well. They're kind of sector rotation strategies, many of them that are pretty well established. I think another approach with sectors is moving away from concentration. When I mentioned those defensive and cyclical blends, each of them you held 5 sectors in equal weight, right? We tried something else in this paper too. We just simply put together all 11 sectors in equal weight and kept it moving through time, and
Mhm.
found that blend also outperformed by around 90 basis points a year over time. And so it does work just to sometimes move away from concentration, especially when some of the biggest names are falling. And another use case I can think of is solving for home country bias. And I think this is important for a lot
Mhm.
of people to think about, right? Um, if I look at the weights of sectors in Canada compared to the S&P World Index, right, which is I think a fair benchmark for this, you'd find some pretty big variations in misweights in what Canada, and it's not unique to Canada. You'd see this in Korea and in Japan, everywhere. There's some kind of tilt, right, away from the global market cap. These weights that vary can leave the hometown investor, wherever they live, with sometimes a lot of exposure to their economy in ways that aren't as diversified as they could be, right? So in Canada, the energy and materials sectors are about 4 times their global weight in the S&P world. Financials is about 2x, with more than 30% weight. That's the biggest sector. But meanwhile, the tech sector in Canada is less than half of that sector's weight in the S&P world, right? So there's some big misweights there, in some of the pretty important sectors, right, from an economic standpoint. And so there's a way to plug in, as we mentioned, some of these globally revenue exposed sectors with the select sector indices that can help fill that gap and manage some of the risks, and also give exposure to some of the areas that are growing globally. And the last thing I'll say on the use case is that when we mentioned earlier around the big liquidity ecosystem and the derivatives, we find in some cases active managers who are still stock picking might go long a stock and then short a sector, or short a sector-based derivative to hedge out that beta and kind of concentrate on that stock. But as I mentioned, that's still a risky strategy, and they've realized it too, which is why more and more we're seeing this evolution and growth of models, ETF models, portfolios that use sectors as the building block, as the driver of alpha-based choices, rather than trying to pick solely single stocks. And so that's, I think, the next wave of innovation, and that's why the whole discussion around active and passive really overlooks that people are using passive to do active in a big way.
That's great. Well, we will definitely need to have you back to discuss the SPIVA research very soon. But I really like the point about using these index ETFs as a stock replacement tool, and something we come back to on this channel a lot. And it allows me to plug our tool that's on our website, bmoetfs.com. We actually have a stock replacement tool where you can type in whatever it is that you're holding, Apple stock, let's say, and it'll populate for you the Canadian listed ETFs that are available to you. That'll give you exposure to that stock, and you can compare and contrast all the different ETFs there. So I encourage everybody to check that out. Thanks again, Joe. That was great insights around sector investing, and I appreciate you sharing all of your expertise with us today.
Thank you, Aaron. Look forward to next time.
Before we close out, I do want to share the list again of our new sector ETFs that we've brought to Canada. There are some definite real advantages to accessing the SPDR ETFs here in Canada through BMO. Number one, you're saving a lot on currency conversion costs if you have Canadian dollars. Number two, you're able to control that currency exposure. So I mentioned there's hedged and unhedged versions. And number three, you can diversify more easily thanks to our lower share price per unit. So in the US listed SPDR ETFs are north of $200 per unit. Here we've chosen to list them around the $30 mark. And then last but not least, you can eliminate some tax frictions. So the BMO sector SPDR ETFs are not subject to US withholding taxes, nor the T1135 filing requirements, as they are considered a Canadian domiciled trust. So if you are affected by US estate tax, consider that, because these are Canadian listed ETFs. That's all for today. Thank you again for joining us. We will see you next time. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.